The broadcast is now starting. All attendees are in listen-only mode.
Hello, Warriors. A good Monday morning, afternoon, evening, wherever you are on the globe. Looking forward to having a good week exploiting markets with our community, both our free community and our special club that everyone should be part of, because you're seeing the tip of the iceberg here in face, but here's the tip of the iceberg. Some of the things I'm seeing that I think could play out this week. We have this bounce in yields that failed at about 275-ish, and to me it looks like this is just corrective. It could get a little deeper, but I'm actually looking for a continuation up before we get lower rates, back up towards 290, 295. So what does that imply? That implies that I'd be surprised if the S&Ps crash from here. Otherwise, you'll be looking at bonds just failing here. I guess they could both be, the bonds could rally and that pressure could put money, you could have a failing stock market. But in general, I think that if the yields are heading up, it's because things may still be okay for just a bit longer in the S&Ps. I know a lot of people were shorting it up here at this 2,600. Kudos to them. Take half your profits. So here we are in the S&Ps, and here's your day. So, right there, stalling here. I think there is a chance that, we get a little bit of a pullback here. I think 25.20 to support the ongoing upside correction has to hold, in my view. I think that they're going to panic some bears. I mean, I was talking about shorting this rally, and a mentee of mine said, well, the problem is so is everyone else. So I'm trying to think what kind of price level might discourage some of the bears and give them second thoughts. And I'm thinking back over 2637 ought to do it, or a push up towards 2690-ish might do it. I've seen counts where you go up here, you go down there, and then back up to 2,800. But I'll be, thinking about it up here. So with that going on, you have the pound outperforming euro. And I still think that the euro is going to head up one more time. I'm actually looking for the moving average to be tested, maybe taken out. That comes in at 1635, 1628, right around there, maybe even towards 17. And what's going on right now is I think people are pretty sanguine about cable. I'm not sure about the fundamentals. I know I'll hear it from my partners about what's going on, but I think there could be a nice opportunity in euro pound setting up maybe around the 61.8 level. Still think that there's a chance for a breakout over 90 that could take it to 94. So I'll be looking to finesse in there. Here's the moving average is at 88.5, which I believe is a fib level right here. Well, it's right in between. That moving average is right in between halfway and 61.8. I'll be trying it here. Maybe it's going to be the market's relieved by whatever does or doesn't happen Wednesday, and the pound's outperforming euro. And then I'm going to look to take some shots down there at that level. Came in long gold from last night. Still think there's a chance that we get one more high here. It's come off a little bit, but we're knocking at the door. One thing I want to caution about gold, which could end up being a great trade later, even if we go up to this line 1305, 1306, is that last week we had an inside week, and early in the week we're challenging last week's highs, most likely take them out. And the most bearish thing gold can do is do this early in the week, and then towards the end of the week be lower on the week and take out last week's low and have some type of bearish engulfing candle for the week. So if the market would have started off lower, I would have been looking for it to do the opposite. But we're coming in higher. We're going to take out the stops, I think, over the double top, right? This little double top, it looks like one on the 4-hour, right? 1, 2. Also, I don't know, this may also be wait for a triangle, and that implies one more thrust out of it. That could be terminal. So that's my view there on gold and yields. And if yields are going to march up a bit longer, you would think that you're going to get, it's lower right now, getting hit pretty hard, that the yen could have one more lift too with yield. So I know a lot of people want to short it, look for it to come in and test this, and I do think that's going to happen. You get a real deep break, but only after these have topped. And I'm not quite sure they have. You look at the 4-hour sideways, just working over off the overbought condition, and look at this moving average on the 4-hour comes in right at resistance. So back over 93, I think the squeeze is on, and I don't think we should take this out. Otherwise, the decline may be beginning under 25.40. So just a few views from an old pro who's been around a long time. I tweeted, in having a long trading career, I've learned you have to take a few jabs to land a good left hook. And time to time, you have to have the will to get off the canvas. Okay? So I've had to get off the canvas a few times. I hope you never do, but most will. I think you can avoid the canvas. And I wish ForexAnalytix was around when I was maybe, 4 or 5 years into my career, so I could really appreciate it. You really can't appreciate it till you've been around for a while, and you've been other places and you've seen what they offer, and then you come here and you look at this type of page with intense detailed analysis of all these different instruments that we trade. The crew provides active patterns in play. Important, I talked about this with Steve, that if you come in, or not if, when you join, it's okay to take the pattern in place, but go to the whys. Okay, so so you're looking at this Noke trade. You have to go the whys and understand. Do you know why you need to know the why? So that you grow and that you learn, and you'll have that knowledge and be able to use it the rest of your trading career. So we have the promo going on. We have a great community of traders that are there many, many, many more hours than face. And also, if you're an early riser and you're in Europe, you can watch Paulie and get some great pivots to consider during your trading day. So how old am I? Oh, seashells? Yeah. Let's just say I took my Social Security early. How's that? Give you a clue? I have Social Security. I'm very insecure otherwise, but socially I'm okay. How you doing? How you doing, Blake? Please save the crowd.
Good morning, Coach.
Hi, bro.
Hey, I hope you had a good weekend.
Yeah.
Some decent football this weekend. I can't believe I can't believe
the Chargers
lost. The Chargers. Yeah. Holy cow.
Oh my God.
Yeah.
I felt so bad for Philip Rivers.
And the Eagles, holy moly.
Yeah.
Oh, yeah. That was a heartbreaker.
Yeah, it's going to be a good couple of good games next week. I mean, Kansas City playing who are they playing? Another shootout team.
Well, yeah, they're going to be playing the Chargers, right?
No.
I mean,
The Rams. The
Rams.
Rams. Oh,
The-
so that'll be an offensive battle.
Yeah, it's going to be a very exciting game. Too bad it's probably would have been the better Super Bowl game, but it's going to be, because I think the last time they met it was like 50 something to 50 something. I don't forget what it was, but it was some sort of shootout. Anyway, so good football this weekend. I hope you had a great weekend.
I did, buddy. Thanks.
Good.
I know you do every weekend. I watch your life on Skype.
Yeah, this weekend I had to get up. I got up really early yesterday morning, and I went out with my brother-in-law and his friend, and we went and shot some stuff. Yeah, we went shot some things out in the desert. So that's kind of what us people here in the Wild West
go anywhere. When I used to live there, you could really just go anywhere, Blake. And
no. We go to a designated desert range to shoot things, but we went really early in the morning, and it was fun. I spent a lot of time with friends and family over the weekend. It was nice.
Cool.
Yeah. So
good weather
and kind of. I'm sorry.
Good weather.
It's a little chilly here. I'm not going to lie. I mean, for Arizona, we're a little chilly. But
flag and euro.
Yeah, as I talked about the week ahead video, I mean, the Euros, the Euro stopped me out actually on Friday, and I was really irritated about that because I played the breakout above the 115 level. I had a pretty large position at 115.10. I was long. My average was 115.10. I bought it, at 115, 115.20. I had a cost average at 115.10, and it was a sizable position. So when we broke down on Friday, it stopped me out as we hit 114.71 is where I got stopped out at. And obviously it's really close to where it's at right now. I'm not long the euro at this point. However, I still believe that the euro dollar is playable to the long side as long as we stay above 114. I think you're just buying dips. I think this is a nice little, rounded bottom here. I'm trying to actually buy it at 114.07 or this the 618 down here. That's where I'm trying to buy it. I don't know if I'm going to get triggered, and going into tomorrow, it's if I'm going to get triggered, it's probably going to be into tomorrow. And the reason why I say that is tomorrow is our meaningful vote for Brexit, and frankly, I think it's going to get rejected. So, just to clarify a few things about the Brexit vote. So tomorrow, the UK Parliament will vote on the government's deal that, and just so you guys know, this is the EU approved deal that Theresa May has brought Parliament, and Parliament is probably going to reject it. In other words, she put together a deal. She's now she put together a deal, got it approved with the EU, with the European Union, had to go back to Parliament to vote on it, and it's probably going to get shot down. And so at that vote, we're expected to get some sort of indication whether it passes or not around 2200 GMT tomorrow. That's the timeline that I've read through my UK contacts. Now that doesn't necessarily mean that's going to be the case. It's just, those are the numbers that I've been reading. And it depends on how many amendments the speaker approves for voting. So we have to watch about all these different amendments that the Parliament tries to push through, and if they're even going to be viable going back to the EU. So it's a very messy process, and it's going to be really interesting to watch the cable tomorrow. But I'm assuming the deal will get rejected, and if it does, the pound may come under some pressure. And then with that happening, I would assume that the euro takes a little dip back down to this little breakout point of this broken trend line. You can see it right here. So I'm assuming that's what's going to get us down to 114.10. So if you guys are, if you're out there buying the euro, you're getting long the euro, just keep in mind that I still think we're going to dip a little bit here. Now, to find out if I'm wrong or not, we get it back above 115, and I'm going to have to. Sorry, I always have the yawns on Monday. And I went to bed early last night. I got a good night's sleep, but we're going to have to get above 115 to change my view that we're not going to dip, and we're going to try to head higher. But I do think this is like a little bull flag pattern, and but I think that that a dip down here is more likely first, and so that's what I'm waiting for. Now, as I mentioned to you guys the last couple of weeks, what I'm trying to do for this year is my New Year's resolution, if you will, in trading, is I'm waiting for charts to develop the way that I want them to develop and take advantage of them that way, versus me, trying to chase around the market and, oh, there's some momentum here, and I gotta, get the fear of missing out, and I try to buy something or sell something as it's moving. I'd rather, wait for the markets to come to my levels, the prices that I want, before taking advantage of it. So, I'm waiting for a move down to 114.10. And if I don't get it, I don't get it, and I have to move on. But that's what I'm waiting for, at least for right now. And that doesn't mean that there's not going to be more, trades developing for me moving forward. I might see something intraday that like, oh, that would be a nice pullback to that area for me to get long or short or whatever the case may be. But anyway, that's what I'm looking at with the euro, and with and just regarding the cable, I'm not convinced with this price action here. I mean, we are, just so you guys can see, we are tagging the 618 retracement. We basically hit new highs overnight above 128.75. We went as high as 78, and then we reversed. So I always get a little nervous trying to buy anything or sell anything when you're so close within proximity of the 618 retracement. So the cable is right up here. Does that mean I need to short it, ahead of tomorrow? I think that's dangerous. It's a dangerous proposition. So I'm just leaving the cable alone. I'm going to try to let the cable guide my trading as far as the euro goes, and not the other way around. Not letting the euro tell me what I should be doing with the cable, because I think the cable is going to be the driver here within the next 24 hours or 48 hours, as we figure out what we're going to do with the UK Parliament's going to do regarding Brexit. One of the other currency pairs that we probably should be following pretty closely is the dollar yen. The dollar yen is still struggling with the 109 level, and that 109 resistance is, in my opinion, going to be very key for the bulls to get a handle on. And if we can't, the risk of failure is pretty high. And if you look at the S&P, the S&P is struggling as we reach 2600. Now, 2600, as you guys know, is the upper end of the resistance zone for the S&P. I had believed, and I still believe, that if we get above 2600, we could probably see 2680, but we aren't even getting above 2600 as of right now. We're really struggling at this near-term resistance, and if that continues, then that's probably going to continue to weigh on the on the yen pairs. So the dollar yen, in order for it to get back above 109, the S&P is going to have to get above 2600, and we're just not seeing that as of right now. So that's the longer we sit here for the S&P, the longer we fail to rally above 2600, the more the risk is mounting for another downside move. And if you look at the S&P, just from a technical point of view, you could probably look at it as having an ascending wedge that looks something like that, which you could also view it as a pennant, which could break lower. And again, I'm really using more the S&P for a guideline to what I should be doing with the yen pairs. And I'm not trading any of the yen pairs. I don't have any position on them right now, but it's just something that I'm, keeping a very close eye on. Now, let's take a look at the dollar Canadian. The dollar Canadian has broken down below this this channel. Now we have longer term channel support near 130. We have the 200-day moving average, so on and so forth. Crude oil has turned lower, and the last couple of days. And if you look at crude, I think we're trying to develop some sort of inverted head and shoulder pattern. As long as we hold above 50-ish, 50, we might dip to 49.80. Today we dipped as low as 50.45 or something. So I think crude is trying to develop some sort of inverted head and shoulder pattern. If that is the case, then the dollar Canadian will probably roll back over again. This has been a very meager and little bounce compared to the sell-off that we've seen in the dollar Canadian. So I think the dollar Canadian is just prepping for another leg lower towards 130. However, in order for the dollar Canadian to really, start another move lower again, we will have to see a rally in risk. We're going to have to see equities, break above that 2,600 and really start to rally. And I think that would, pave the way for a higher, a higher bounce in crude, back towards 55, back towards 60, and crude then allow for the dollar Canadian to move towards that 130 level. And again, I'll say it again, we haven't really seen that indication in the S&P. The S&P is kind of struggling here. So I'd like to see a bid come into the S&P before I, thought about shorting the dollar Canadian, but we'll be watching it here. I was actually looking, I was actually looking for the dollar Canadian for a bounce on Friday. I was hoping we might bounce back up to 133, 50 and turn lower again. That's what I was hoping would happen. But with all the Canadian data that we got on Friday, which was Canadian CPI, if I'm not mistaken, it just didn't allow for the Canadian to move much. So
you called out in the room, Blake, that crude was peaking on Friday. That was a good call, and maybe to fill out that right shoulder, if it goes lower, it could take Canada up to your ideal sell zone.
Yeah, I was hoping that crude would, come back down, drop below 50, maybe stop out some traders below 50, and then bounce. And I thought that would be the catalyst that would drive the dollar Canadian a little higher towards 133 and change. But it just didn't materialize. But that's what I was. Yet is correct. But that's
no, let them come to you, buddy.
I'm trying, that's been that's the rub right now, is I'm letting the trades come to me, and I spent a lot of time chasing the markets around last year. And I'm going to kind of reiterate what I told you guys on Friday. Last year was a challenging fall for me, and I was profitable, but marginally. And usually October, November, December are my rake it in months. Those are the months that I really tend to do very well. We get, higher periods of volatility, but it was very difficult when the euro dollar was in such a consolidation mode last, fall. And for those of you that traded it, know exactly what I'm talking about. The moves would start and stop, the breakouts would fail. So if I just spent more time focusing on allowing the market to come to me and buying or selling where I wanted to, versus, oh, hey, we're going to break out here, so that looks bullish, or hey, we're going to break down here, that looks bearish, and trying to chase the market around, I would have done a lot better. Because, I look back and it's like I have so many trades where it's like, oh, I lost a little bit here, I lost a little bit there, I lost a little bit there, and then I made that one, trade that did exactly what I thought. And it's like, wow, okay, great. I made money there, but because of all my little losses, I ended up spinning my wheels more than anything. So yeah, I was profitable, but I could have just been a lot more profitable if I just would have sat around and waited for the trades to develop that I wanted them to develop, and just, gone with those. And I think that we are still at this point in a that type of market. And the reason why I found that out on Friday is because, I bought the euro on a breakout, thought we were breaking out here. And then on Friday, we slumped back below 115. I'm like, great. That there's another indication that the market's not primed yet for that, that type of volatility where we can, really, kind of chase the market around in a good way, meaning we can chase it because we have some volatility, which will allow us better entries and exits. And it's still a consolidation, unfortunately. So tomorrow, I think, might loosen some things up a little bit, especially, once we get past the UK Parliament vote. So my optimism for later on this week, when I say later on this week, like tomorrow, late afternoon, for us here in North America, or going into Wednesday, Thursday, Friday, I think we're going to have a lot more exciting week going into this latter part of this week after getting through this meaningful vote in Parliament in the UK. So with that being said, I'm gonna call in my colleagues, Steve and Stelios. Good morning, guys.
Good morning, Wade.
Good morning.
How you guys doing?
Very well.
Good. How have you been?
Good. It's been a pretty quiet session overnight. Not a lot moving. I think some of the cross rates are moving pretty well. I know in our chat room, Amanda's been talking a lot about the Euro New Zealand and the Euro Pound. So I think we're seeing a lot more moves in the crosses than we are in the major currencies at this moment.
Yep.
Where's Amanda's head at on Euro Pound?
She's more looking at like a downside move. She'd been noticing the failed breakout attempts of the Euro Pound. I'm watching this support really carefully because it's a very messy bull flag pattern. But we get much lower here, and you have to just kind of be more bearish the euro and a little bit more bullish the cable. But that would be just my quick gut thoughts, but yeah,
I'd watch those bid levels for taking profits if I was short.
Yeah, I mean, maybe down at the 50%. I have obviously with everything that's happening in the UK, it's hard to be too bullish the cable just yet, but things may change dramatically in the next 24 hours or 36 hours or so. All right, Steve. Great. Well, I'm going to pass it over to you guys. I want to mention if you haven't taken advantage of ForexAnalytix, make sure you do so. This is like the last week that we're running our beginning of year special, so New Year's special. So make sure you take advantage of it, and make sure you also talk to our partners at Forest Park FX. I actually have a friend that his father is looking to do some trading in the currency market, and I actually just forwarded Trent's information over to him, so he can hook up his dad, and that's how comfortable I feel with Forest Park FX. Is I recommend it to my friend's parents. I mean, so yeah. I said, hey, you got to talk to Trent and Justin over at Forest Park FX. So if you haven't done so already, for you guys at home, you should. All right.
Yeah, it's all about trust, man.
It really is. All right, guys. So thank you so much, and Steve, I'm sure we'll talk a little bit more about that. And you guys have a great Monday.
Good hunting, man. Stay patient, bro.
Thanks, guys.
I'm also a client of Forest Park FX.
Yeah.
I've already received, during the past 2 months, my.
Well, that shows that suitability too high there.
Yeah. So you can also subsidize your ForexAnalytix subscription through that, or if you're a US client, get cashbacks, rebates. So you can find it under investment program. Here is the Skype contact and the email address. So
have you gotten a check yet, Steve?
Yeah, twice already.
Nice, isn't it nice? From just doing what you were doing anyway.
It is absolutely nice. Yes.
Yeah. Mailbox
this is actually,
money.
You won't actually believe that. I just received an email with this month's, and I'm not kidding about it.
Yeah, yeah. Do you look back and go, "Wow, look at all the money I could have had"?
Yeah, that's actually true.
You do that?
Yeah, I do. Yeah, and I don't even want to. I don't even want to add. I don't even want to add it up for so many.
Yeah, I know what you
anyhow.
mean.
Yeah.
I thought I just, bring it down
Yeah.
a little bit before you did the
Yeah, I know. You old wolf. I know what you're doing there.
All right, brother.
Before you start, just a quick comment on the UK.
Absolutely, Stelio.
So that we have this big binary event. If it happens tomorrow, we've had one postponement already, but if it happens tomorrow, it's going to be a big binary event. Now, the question we have to ask ourselves is, what do we think the likely reaction is going to be? Because it's not like if the vote is passed, the cable rallies 100 pips, and if it fails, it sells off 100 pips. It's all about what the market's pricing. And from all the comments from the various MPs, it really does look like there's no way in hell this thing is passing. The way it is at the moment, that is. So, you have Labour definitely not voting for it. You have the DUP, even a few like an hour ago, they just said again, there's no way they're gonna vote this. Even a whole bunch of Conservative MPs are not going to vote for this. So it looks like this is not happening. The question is, what happens next? And what Theresa May is saying is that, if this deal doesn't pass, what happens? Is there a no-deal Brexit? Is this what's going to happen? And actually, people like Jeremy Corbyn, he's been saying that a no-deal Brexit is something that has to be avoided completely. So, it looks like the alternatives are either, if this doesn't get passed, either there's some kind of other deal that gets pushed through. I mean, I don't know what's going to happen, or there's a postponement of the March deadline. So it's, what's going to happen? Who the hell knows? But the question is, what are the scenarios afterwards, and what is priced in terms of all the potential scenarios? And given that the fact that it's really, at least it looks like in this way at this moment, that this is not going to pass. The question is what happens next, and we all know how politicians can change their minds and do crazy things. We saw the Greek government get pretty much not dissolved, but yesterday, they one of the two, not the main party, the support party who has been supporting Syriza at the last elections, they withdrew now. So we have a lot of uncertainty here in Greece. Obviously, it doesn't really matter that much in FX, but politicians are very unpredictable. That's what I'm.
How does it matter in the streets of Athens?
Nothing's changed yet, but. It's
it's just amazing. France and Macron praying for people to the yellow vests and everything. I mean, from here on the side of the pond, things look orderly here despite our government being closed. So it's not orderly, but disorder everywhere still.
Yeah, absolutely. And actually, the other thing I read this morning, and I couldn't help laughing a little bit, was there were the latest polls in the UK in terms of where each party is polling. Conservatives are still 5 or 6 points ahead, which is, if Labour can't get ahead now with all these shambles, it's really a messy situation. I mean, when are they going to get ahead? So that was a bit funny.
Yeah, Amanda said the middle class is suffering pretty. Suffering there, and this is without them being in a recession.
The middle class in general is being squeezed, throughout the vast majority of developed world countries, and this is a very worrying trend, Coach.
I've been squeezed, Steve. I got squeezed so hard, my eyeballs popped out of my head. And they're back in the pocket now, but they popped.
And in general, the whole global economy situation is not looking good. Is not looking good. And as you said, and all that theoretically after a very prolonged expansion. So imagine what's going to happen during the next recession, because there are a lot of middle class families
There's going to
that
be massive social unrest everywhere.
yeah that managed to go through the previous recession and the period that followed.
I know why Blake was out, getting his eye back on the range. There was. It's not funny. There are a lot of people. The preppies have been talking about this for a while. So
yeah,
I don't know about you. I'm not a survivalist.
Yeah, I'm not a survivalist either.
When I camp, I want to be in a hotel room.
No, I'm 100% with you. I want to have an air conditioning and a nice bathroom to have a shower, right?
Yeah, exactly.
Yeah, I know exactly.
So what do you think with Euro, Steve? Do we still get one more pop up here?
It might be the case, but one thing is for sure: you shouldn't be selling euro here. Why?
Yep.
Because we're certainly retesting previous resistance and support. So selling it here makes no sense, right? If we lose this 114.50 area and we close below it, then we can start talking about a false break higher. Until that happens, there is still the potential of having a breakout, a pullback, and another push higher, right? So euro is.
I'll go with that.
Yeah, euro is currently sitting on support. So keep that in mind, everybody. I'm not going to go into detail because Blake covered it. The cable, on the other hand,
could be under pressure because people are actually gravitating towards cable. That's why EG is coming down. And what would be their reason for positioning short euro pound? Because they think there's going to be a sanguine outcome.
Listen, Stelios described the situation which we've seen in the past multiple times. What is that situation? It is a situation. It is a situation that it's 99 priced in that we're not going to have some kind of a resolution tomorrow, right? Okay. So any potential surprise is going to be hugely pound positive, right? So if we don't have the vote passing, which is 99%, no real damage should probably come to the pound because it's not that the pound is pricing in something good. On the other hand, imagine if we get some kind of a surprise or a delay or whatever, there is the potential for a squeeze. The market is also positioned very short, so there is a potential for a squeeze. Having said
131, 131 if they squeeze it?
I'll tell you. Having said that, we're currently testing confluence of resistances. Why? Because this is the 61.8 of this last leg lower, and at the same time, as you see, you can draw this if you ignore that flash crash lower as an ascending channel. So if for some reason we do push above that, we should find ourselves quite immediately at the 130 confluence of resistances. And as you see, there is a descending channel here. I think that if we pass, as you see, this channel is also coinciding with the 200 daily moving average. They're actually converging. They're almost touching now each other. So if we that passes from 131, so if we actually break above 131, I think there's going to be some kind of a major squeeze. Wow. So 130 and 131 are resistance areas. And a break above 131, I believe, is going to trigger a massive squeeze that can easily produce a move to 136 in 0 time. So, but all those are ifs. Let's first see if the cable manages to produce something following tomorrow and passing through this confluence of resistances that we're currently testing, and then we can talk about the rest. Now, having to do with the euro pound, I'm actually having, looking at the euro pound through a different pair of eyes. You can even.
That's what I'm looking for.
Yeah, you can even interpret this as a rectangle that has just broken down to the downside. So if we go down to a 4-hour chart, you can see it here that we had a range. We were oscillating within this range, and we broke below it. We came up. We retested this breakout area, and we seem to be pushing lower. So I have to admit that this is a bearish outcome. When we first entered this range and we started consolidating here, I believe that this looked like a consolidation that could produce another push to the upside. But spending more and more time and being unable to make it above it,
I think more like distribution to you now.
Yeah, but I want to see a euro pound close below 88.50 cents to start looking for something bigger, because then we can start talking about a possible, triple top, double top, whenever, depends on how you want to look at it. And then we can be talking about more downside. One thing is for sure, as long as we remain below 89.50, at least a move towards 88.50. You can see here 88.50 is previous support resistance. The 200 daily moving average is also there. So we can easily make it down to that level. Obviously, the euro pound doesn't seem to be in a rush going anywhere. I mean, we spend a lot of time consolidating and not doing much. I mean, just think about it. Since when is it? September 2017. You can even interpret this as a broadening range, but it is more or less a range. So I think there are better opportunities out there instead of trying to figure out what the euro pound is going to be doing. Now, what looks quite good to me from a technical perspective is USD yen. USD yen, we said it last week as well. How does this look to you? Because it looks to me like a bearish consolidation, right? I don't know if it's going to prove to be a bear flag. I don't know if it's going to prove to be just a little triangle, and we might, if that's the case, we might break down from here imminently. But I can't really find a way to interpret this as some kind of a bullish formation. So USD yen looks to me like it wants to push lower at least once more, and given that, if we go back to the indices, because I think that the vast majority of the indices are at interesting points. So let's start by the Nikkei, since we just mentioned the USD yen. As you see, the Nikkei is more or less producing the same kind of consolidation that we're seeing in the USD yen. This can easily be like a bear flag. Okay, this has already happened, so let's project this lower. So this can easily be a bear flag. We found resistance here. So, if we move back down to 19,500 and we break below that, I think that we're headed to new lows from there. If we look at the FTSE, you remember that we were looking at two levels as possible levels of resistance. The FTSE, one of them was this horizontal support resistance area here, which we did break above, but the other one was the extension of this triangle support, and we got rejected exactly from there, and we're now back down in this area. So now things are quite simple. If the FTSE finds support here, then we go to this scenario, which we drew last week. Okay, we go to this scenario that we have more upside. Now, if we lose, on the other hand, this 6,850 area, then we're looking at least for a retest of these lows. So I think that it's quite simple. FTSE currently on support, and what happens from here will indicate the next move and which direction that's going to be. So now, having a look at the DAX, the situation is more or less the same. I was very explicit about it. DAX 11,000, the 11,000 area is a previous level of support. I said multiple times that I cannot turn bullish the DAX unless we clear 11,000 to the upside. We got rejected from there, but now it remains to be seen what we're going to do from here, because there is the bullish case scenario, which is that this might be an inverted head and shoulders formation, in which case I wouldn't want to see the DAX go much lower than 10,700. So if we build some kind of a base from there again and move up again towards 11,000, then I think this is going to provide a very nice opportunity to trade the upside, having a well-defined formation, an inverted head and shoulders formation, which is going to be projecting quite higher. On the other hand, if we lose this support area, we should be looking for this kind of scenario to push to new lows. So DAX and FTSE, very interesting to monitor. I think that both of them might produce some very worthwhile trading opportunities within this week, quite likely. Now, let's go to the US stocks. So one is the Russell. Russell has had quite a nice... I've seen that we have some questions, by the way, and I will cover them. Don't worry about it, guys and girls. I see we have questions about two people asking about USD Swiss. Relationship of yen and S&P. Yeah, we can cover that. We can check at India that we have a question. More questions about the USD Swiss, and we have a question about soy and corn. Can you please, Robert? Can you please send me? I don't cover those commodities, but technical analysis. So if you can put on the chat the tickers, I can have a look at them very easily. It's interesting anyhow for me. I have no problem checking other markets. Having to do with the Russell, Russell has pushed higher, quite convincingly, but it's also reaching the same kind of situation that the S&P reached, which is what? Testing or almost testing previous triangle support or horizontal support, depends on how you see it. By the way, I'm already quite comfortably in the money here because, my third quarter of my short got triggered, barely got triggered actually on Thursday. So I have a cost average of 25.83 almost, if I remember right. So I want to see what's going to happen from here. I wouldn't exclude another push higher towards 25, 25.30, something like that. But I think that that's going to be a key level for the S&P. So S&P might get rejected from here, might get rejected from a little bit higher. But I do think that the risk-reward ratio is quite appealing for shorts. The higher we go towards there. The same deal applies with the Dow. 24,250. We might make it to there. Quite a nice level. And the Nasdaq also is showing the same thing. I mean, we might have another push to the upside, but I would be very careful here. Roughly at 6,700, 6,720. There is a descending trend line resistance. So, I wouldn't be buying US stocks. I mean, you don't want to play them to the downside. I completely understand, but I would definitely not be buying them up here because almost everything is currently at resistance, and that's something that you shouldn't probably ignore. Right now, we had many questions about the USD Swiss, so let's go straight ahead and have a look at the USD Swiss. So, good news and bad news about the USD Swiss. So, good news: the move, if you want to be bullish, good news. The move to the downside has been very orderly. So far, doesn't have any impulsive characteristics. Second piece of good news, we held the confluence of this ascending trend line support and this descending channel support down here, right, at 97 and change. So, that's the positive way of looking things. So as long as we're holding above that, it probably doesn't make much sense, being bearish. On the other hand, as I said, we've seen a move to the downside, and if we do break this area, I think there is more potential for a push lower. Now, the reason why I'm not really bullish the Euro USD is the fact that if I was to look at the USD Swiss chart on its own and completely ignore correlations, I would feel more comfortable buying it on a breakout of this descending channel. And obviously, the USD Swiss pushing to the upside, while at the same time Euro USD is also pushing to the upside, is not something that's likely to happen. So this is why I never wanted to follow a breakout in the Euro USD to the upside, right? So on the other hand, I have to say that we did find the resistance once again at this 98.50 area. You can see, if I zoom out, you can see that 98.50 has been support resistance multiple times in the past. So buying it up here also doesn't make sense. So bottom line, things are quite simple with the USD Swiss. If we do see a daily close above, let's say the 200 daily moving average, which is at 90, I think that you can feel comfortable that it's going higher. On the other hand, if we do see a daily close below this previous low, I do think that there is more downside. Okay, so anywhere in between, which is anywhere in between 97 and 98.50, I would rather do nothing. So I don't think you should be jumping the gun within this area, but you have well-defined levels that if we break, you can definitely have a stab at seeing some follow-through. As I said, I would be more willing to see follow-through to the upside. And another extra indication for that is the RSI. The move in the RSI is also showing me a corrective move, right? Because just look at the RSI. The RSI went from overbought conditions to, to a neutral reading, quite slowly and orderly as well. So the RSI is also showing me that probably the path of least resistance remains for a move to the upside. So that's my view in that has to do. Okay, soy, S, corn, ZC. Okay, let's have a look at them. ZC. Is there some kind of a continuous? Whoa, this is a very bearish chart. Oh no, this is something different. Zim to capital. Nope. Let's say both are futures, so it's the current contract which is being traded. Okay, ZC. One exclamation mark. Let's have a look at it. Okay, there we go. Yeah, this is a very bearish chart. I have to say that. So clearly we have a consolidation here. And, a very well-defined triangle. The previous move was quite impulsive to the downside. I have to say that, obviously you can't have such an extension to the downside because this is obviously a commodity. I mean, it's a commodity that has, a minimum value, obviously, right? I mean, there is production costs, etc. So the thing, as I've talked about commodities in the past, commodities always have a distribution that's not a normal distribution. That has a fat tail to the right side, simply because they cannot trade for a long period of time below production costs, etc. So I have to say that this is a triangle. This looks like it can have a push to the downside, but I would, if that happens, I would be looking for that push lower to be a terminal one, right? So my ideal scenario here from a technical perspective would be an eventual breakdown and then a big reversal and some type of a big recovery starting from there. One thing is for sure, if we zoom in, you can see that without a doubt we're currently trading in the middle of a triangle, which means that unless you're a day trader, there is absolutely nothing you should be doing here. And if I want to have a closer look at this move, the last two moves that happened here in the corn market is a move that looks more impulsive to the downside and a move that looks more corrective to the upside. So I would expect that this move will eventually fail. The closer we get to this trend line, the likelier that is to happen. For another push lower towards the triangle's support, and as I said, if we do make it below the triangle support, I would be expecting another thrust to the downside, which will likely be terminal. So I think that the risk is for a move to the downside without excluding the possibility of a little bit more upside first. Okay, now let's have a look at soy, which is, you said, S exclamation mark, S1 exclamation mark. Okay, even yeah, this is going to definitely fail here. Very impulsive move to the downside. There is no question about it. And this move to the upside has clearly corrective characteristics, right? So let's flip this. So even if we have more upside, I would expect an eventual breakdown. So monitor closely this ascending trend line support. It looks very unlikely that this is the beginning of some kind of an impulsive move. The only way that's the case is if that's like a it can be a diagonal in it, but it's quite unlikely. Most probably this is a corrective move and it's going to fail and produce some downside. So anywhere between this can even be a double top, right, at 928. But up to 946, 947, I think it's going to be very tough for the soy market to make it above there. So both of them look quite bearish. I would be very, very hesitant buying it. I think that your chances are to sell it once you get confirmed breakdowns. That's what I think. Question about Euro Swiss, Aussie, Kiwi. Sure, a lot of questions today. I like it. Let's have a look at the Euro Swiss market. Okay, Euro Swiss. First of all, as you see, we've been moving lower since October 2018. This move looked corrective in nature. I mean, I had marked it as a pennant. We are moving lower. We're moving lower in quite an orderly way, and we did find support once again at this 112 area. So I have to say that close to 112, I wouldn't be short close to 112. But if we do see a breakdown below 112, I do think that we're going to see continuation to the downside, with the next area of support being roughly at 110. Okay, 114.50 remains resistance, and I do think that as long as we remain below 112 and 114.50, you probably shouldn't be doing much. Okay, so that's what I think about the Euro Swiss. Euro Aussie, let's have a look at it. Okay, Euro Aussie. I like it to the downside. I said it last week as well for multiple reasons. First of all, we did see a break to new highs that only held intraday and left behind this magnificent bearish candle. So that was a false break higher. And since then, we've been respecting previous support as resistances, and we're currently testing another support area. So if we do lose this support area, I expect us to test 157.50 quite soon. But obviously, if you don't already have a position, don't sell it right on support. This is like a confluence of supports here at 158.70 roughly. So I like it to the downside. I liked it to the downside when we were here as well. Back then I preferred to sell pound Aussie. I booked half of my position, but now Euro Aussie seems to be underperforming, so it looks good. But as I said, it's now on support, so it looks good to me for more downside. That was a very nice reversal, and I like it to the downside. As simple as that. So I think any pullback to 160 is probably a good selling opportunity. Okay. As I said, don't sell it here. 160 though might be the level. S&P and yen, what is the relationship? Usually they have an inverse relationship. You asked about yen, so I'm answering about yen, right? I'm not answering about USD yen because you're mentioning yen. I want to make that specific. So usually, because yen is a safe haven currency, when we see risk-off moves, the yen goes bid. So in essence, the USD yen falls. So there is a direct relationship between usually the stock indices and USD yen, or an inverse relationship between stock indices and the yen. Okay, so that's usually the case. Now there are times that yen might be following more what yields are doing. There are times that are more affected by what the S&P is doing. But on the other hand, the yields are also correlated very closely to what risk is doing. So that's why that's why I'm not separating those two relationships, because in essence, very often it's one and the same, right? So that's the usual relationship between the two of them. Can the S&P fall and USD yen go up with yields back above 3%? Yeah, the thing is that it's not easy for that to happen. I mean, for those things to happen at the same time. Most probably, if we assume that yields will be moving higher, but at the same time risk is going to be off, which doesn't work like that usually. I believe that since the USD yen is going to be pulled in two different directions, it's probably going to end up doing more or less nothing. So in this case, I think that your best bet would be to trade other things and not try to determine if the USD yen is going to be more affected by what the yields are going to be doing in comparison to what risk is doing. Okay. I think there will be better opportunities if those things are happening that you mentioned. We have questions about the Aussie and the Kiwi, and then about pound card. Okay, so let's begin with Aussie. I like the fact that the Aussie pushed to new lows and then showed quite a nice recovery. So I think there is the potential for more overperformance in comparison to other currencies. I know, coach, it's time, so I'm going to go very fast over them. Kiwi looks very good because it broke above this descending channel. So I'm expecting that we can potentially have more upside towards the 61.8 and previous support resistance area at 70.5 cents. And let me also go fast over the pound card. So pound card, here it is. Haven't had a look at it in some time. As you see, pound card is more or less treading water, right? I have to tell, yeah, chop fast, really. I have to tell you though that this move to the upside looks anything but impulsive, right? So I would be very, very, very careful here because this whole move looks to me corrective in nature. So I would expect, let's draw just a single trend line here. So roughly we have some kind of a trend line like this. Right, let's make it another color. Let's make it blue. Let's draw a parallel. And I think that you have here roughly some kind of a channel. I think that this is the path of least resistance. Like, right, and move to the downside from there.
Concur.
So, yeah. So that's what I would be looking for here. Okay. So thank you all very much. We'll be back here tomorrow. Coach, enjoy your interview.
Okay, Steve, great to have you back in full voice.
Oh, yeah.
Really, yeah.
Great to have my voice.
Yeah, glad that you're 100%. And Peter, Happy New Year to you. I'm just going to make you a panelist, and then I will show my screen so we could show your website. Happy New Year, Peter. Let's see if your mic.
I just unmuted.
Can you hear me?
I can hear you now, Peter. Happy New Year, buddy.
Yeah, you too. Thanks for having me again.
All right, it's great to have you, Peter. Excellent time to talk to you. Finally, what you had been talking about for a year, even though the market went nowhere, the market did not recognize the shape of what could happen while the Fed was trimming its balance sheet, which is something you've been warning investors about for quite some time, and better early than late, don't you think?
Yeah, I think people forgot the giddiness and enthusiasm that QE created, and there was this market nonchalance that QT would not be that big of a deal. I mean, for a while it was not to markets because the Bank of Japan and the ECB were going full throttle. But as that began to recede, it all of a sudden began to matter. So in the fourth quarter of 2018, the net liquidity changes on the balance sheets of the Fed, ECB, and the BOJ went to a zero as of October 1st, and the market topped out 2 days later. And then in Q1 of this year, we have now a liquidity draw. If you add up the central bank balance sheets of the three, since the ECB is now no longer expanding the size of its balance sheet. So I still think that'll be a factor, major headwind for markets this year. Obviously, now there's a question of how much more the Fed's going to let the balance sheet decline. But as long as on a monthly basis, they are letting it shrink, I think that will continue to be a headwind for flows here.
Okay, so last time you were on, Peter, you said you liked emerging market debt, and I really don't follow any of those instruments, but I'm assuming it did okay because even U.S. Treasuries put on quite a rally during risk off. How did emerging market debt do with the sideways dollar?
So it actually hung in. It was EMLC, Eddie Mary Larry Charlie, which is the local currency EM ETF that I like, was actually unchanged in December. So considering the carnage in many other areas of the market, that certainly is a victory. And then in the first couple of weeks of 2019, it's had a nice bounce, coinciding with the dollar weakness because of the Fed being more dovish and likely backing off more rate hikes. So I still expect continued pretty good performance in that space with a pretty good dividend yield.
Okay, so why don't we talk about the Fed now, Peter? Because it seemed like they had they got religion at 2,300 or so in the S&P, and they started talking about all the dot plots came back to maybe one hike, maybe even an ease. Do you think that it really depends on where the market is to what the Fed is going to do? Say, for example, we're rallying into March. Do you think they go ahead and tighten? Whereas if the stock indices are falling into March, they stay pat. Are they that market sensitive about what ongoing policy is going to be like?
No question. So now we've defined the strike price of the Fed out of the money put at being 20%, and that out of the money all of a sudden became in the money at down 20%. So they definitely focus on it big time, because that's what one of their goals was to juice asset prices through all those experiments of QE. Exactly. So this certainly goes back to Greenspan and the asset price dependent economy that he created. And all anyone has to do is just look at a chart of net worth relative to disposable income, sort of a metric of asset prices relative to the underlying economy. And you can see that ratio is at about 700%, well above where it was in 2000, well above where it was in 2007. So we are hugely dependent on asset prices. I think the Fed understands it, but certainly not to nearly the same extent as they should, because they keep talking about financial conditions, whether they're easing or they're tightening, but they don't seem to understand that their actions on rates in the balance sheet is the reason why they tighten and they ease. So when they raise interest rates, when they shrink their balance sheet, financial conditions tighten, and then that causes worries about growth. And then the Fed says, well, financial conditions are tightening, let me back off. And then they start to ease again. And I don't think they realize that it's a cat chasing its own tail. They still think it's somebody else's tail.
Okay. So that's confusing. So they're confused. And what do you think their course of actions could be? People think the Fed's infallible, but how many times have they overshot on both sides? Quite a few times, even with a 100-year track record. So are you betting that they overshoot by staying tight too long? And okay, go ahead, Peter.
No, I wouldn't be surprised if they were no longer going to be raising rates this year. But to your point earlier, if we do keep on rallying and the economy actually does stabilize, well, then they will raise. So there's this pick your poison thing. They're done now because the growth is going to slow, where they keep on raising because growth gets better, but at some point growth will eventually slow. Because we have to remember, the economy and markets ebb and flow now with monetary policy. We are tied together. We cannot separate it.
Twins, right? There was no handoff. There was no handoff that we thought we were going to get, right?
When you are in a credit addicted, credit dependent economic cycle, it is intertwined. Whereas historically, before the 2000 and 2008 recessions, recessions were caused by more of inventory changes and changing in savings rate. We've never been this addicted to the cost of capital and liquidity. So it is intertwined. So the Fed is in a no-win situation no matter what they do. Now, that said, I do think they're probably done raising rates, because I do see the economy continuing to slow, both here and overseas. But the balance sheet's going to continue to shrink for a period of time until we get some more accidents.
Okay, so would an accident under this law of the S&P weekly chart that I'm showing right here, and say, I know a lot of people are looking for, maybe in this range down here, Peter, would that be enough to cause the Fed to panic and ease?
Well, the first thing they'll do is they'll say, okay, we're no longer going to shrink the balance sheet, and then they'll look around and see what's going on. But yeah, at some point, if it starts to filter into the data, because they keep talking about the data driving their behavior, well, yeah, they'll start to cut. But the problem is that is the Fed just going to go back to the old playbook of cutting rates back to zero, and if that doesn't work, doing QE and thinking they're going to get some better result? I mean, at the end of the day, changing
what other
rates,
playbook do they have besides?
Well, they don't. But the question is, do they think that cutting rates is actually going to help when you have an issue of too much debt?
Yeah.
By lowering the cost of money, is that really going to matter and encourage people to take on more debt? I argue it's not going to be in the next downturn, and that will separate the next downturn from previous ones. Is the Fed won't have much ability to stimulate economic growth. The ECB will not, the BOJ will not. So any downturn we get is not going to see the typical V bottom that many are used to.
Okay, well, maybe it doesn't last 10 years and it has effect for 10 months. What do you think of that?
Well, we'll see, but I think the next economic downturn, the next sell-off in markets, could bounce along a bottom for a while, and instead
like
of
an
a
L,
bottom, a bathtub such.
All right, so I know you've been constructive metals, and we have a decent formation here, and even a lot of traders I know that were bearish and looking for one more washout are starting to change their tune. That now you should be buying breaks at 1270, 1250. Do you think the gold is smelling what you're talking about? Because this gold advance, Peter, happened without a weak dollar. I mean, the dollar's mainly been sideways. We finally got a little bit of a hit late last week, but euro's struggling. Maybe it could rally to 117. But gold did this on its own. What do you think is behind it? Smelling exactly what you're talking about? Safe haven buying?
Well, we have seen dollar weakness against emerging markets. I mean, even the Chinese yuan last week got to a multi-month high, and even the euro. I mean, when you look at all the challenges that Europe faces, they still have trillions of dollars of negative interest rates. The ECB balance sheet relative to the size of the European economy is bigger than the U.S. We have growth that is going to maybe have a one handle on it this year. We have political issues, and the euro is still trading at 115. I actually think the euro trades remarkably well in the face of all those challenges compared to the dollar. So I'm actually impressed by the action in the euro. But importantly, real rates, which is what gold really should trade off, real rates are at the lowest level since the middle of September. So we had a 4-month low in real rates. That has been
zero. Is it around zero right now?
Gold. Well, if you go out 5 years, I like to look at the 5-year, and real rates are positive by about 85 basis points. But at the end of November, it was $1.15. 1.15% in real rates. So that fall has coincided with this decline. This increase in gold, but also being helped by the weakness in the dollar.
Okay. All right. So we're looking at gold. As you can see, when I put the two charts together, gold has way outperformed euro. Maybe what's been going on is gold has been rallying in other currency terms, and finally is rallying in dollar terms, because all these other currencies have been under pressure. If you own gold, you did okay. Now it's finally happening in dollar terms, or maybe across all fiat now, which would be a real bullish signal for gold if it's rallying against all fiat. So I'd like to go to an article that you wrote here, Peter, on your website, and show people that they could subscribe to it. So this headline: shut down China, euro, OPE 70%.
Well, Europe, yeah.
You're up. Okay, you're up 70%. What's the cliff notes on what you're trying to say here? You wrote this today.
Well, I think with respect to the shutdown, to me, there are a few guarantees in life: death, taxes, and if the government shuts down, it'll soon reopen. But this is lingering on longer than I think most people imagined, and I'm really not concerned about the shutdown. Yeah, I'm not really concerned about it because I know it's going to reopen at some point, and it will clip GDP estimates, but a lot of the lost pay will be returned. But there will be some business that's not going to be recaptured, and now that you have the shutdown affecting the TSA, I think that is going to be the impetus for a deal sooner rather than later. That now you're beginning to piss off the average person, and setting aside the pissed off people that actually work for the government that are not getting paychecks. But now once you start pissing off the general population who just wants to fly from point A to point B, then the politics get messy for both sides. Now, with respect to China, we had trade data that was weaker than expected, and certainly is a catalyst for the weakness we're seeing in markets everywhere. And we saw continued softness in European data, and it's just confirming that global growth is slowing. And we are on the cusp of earnings season in the U.S., where 40% of S&P revenue is sourced overseas. And while I'm sure that 70% of companies will beat earnings estimates, because that's always the case, I'm expecting a lot more revenue misses relative to expectations. And
the banks leaded off. The banks leaded off this week, right?
Well, yeah. So Citi reported today, and they beat EPS, but they missed revenue. And I think that may be a common theme throughout earnings, and that you're going to get a low level of companies that are actually beating revenue for the reasons I stated, whereas on the bottom line standpoint, you can easily beat revenues because you lower the bar, you buy back stock, you cut costs, you trim your tax rate, so on and so forth. But watch the revenues and certainly watch the guidance.
And the 70%, that means what?
The 70% is about 70% of companies historically beat earnings per share, but that's the bar. So if we see that again, that doesn't mean earnings were good. That just means that they were normal. So anything below that would tell you that that would be disappointing, and vice versa.
Okay. I know that almost everything that you look at are, based upon fundamentals. And I'm curious as to what you think, if there is some type of market analog between presidential problems and potential impeachment, between the Nixon era, which I believe we entered a bear market for quite some time, and what's happening today. Do you see any parallels between that? And maybe can this even have heavier weight than Fed action?
I think at this point, with respect to the Trump administration and what markets want, they got what they wanted in the tax cut. They got what they wanted in terms of regulatory relief. And the next thing they want is resolution on this trade situation with China and getting rid of these tariffs, not just with China, but these steel and aluminum tariffs elsewhere. Anything else that happens with Trump, whether it's impeachment, whether it's Democrats just continuing to make his life miserable, I don't think the market cares. The market wants this trade situation resolved. And I think everything else pales in comparison at this point, again, because he got his big legislative initiative in place at the end of 2017 and being in the tax bill.
What about the fact that I think Fitch is talking about a downgrade of U.S. debt?
As long as we have a printing press, everyone will get repaid. It'll just be what's the fate of the dollar in that. So I see the downgrade being more of an impact on the U.S. dollar rather than anything else.
Okay, Peter, and do you believe the recent lows that we had after the worst December since the Great Depression are going to hold or be taken out by quite a bit in most of the major U.S. forces?
I think there's a greater than 50% chance that we're in a bear market. So if that's the case, after 10 years of an extraordinary run, extraordinary monetary policy, this bear market's not just going to end in 3 months.
Do you think miners will act more like gold or act more like stocks if we get a sell-off like that?
Well, it's a good question. I'm sure some days it'll act like stocks, but I'm hoping more days than not it acts like gold.
Okay. Have you noticed the gold-silver ratio has shifted over the last month or so?
Yeah,
Peaked at a
silver's
pretty
beginning to trade well. Yeah, and I think the whole space with you, now you're able to take the Fed, outside of the balance sheet shrinkage, at least on the rate side, you're basically taking them off the table. So, like, I don't believe that, okay, the Fed hiking is negative for gold, because again, you have to look at real rates, not nominal rates.
right.
But there's plenty of people that do take that into account, and now that they're probably done raising rates, you can take that off the table. And so now I don't really know what the bear case is for gold anymore. If the Fed's done, the dollar's weakening. To me, this is just the beginning of what could be a really nice ride.
Any view on Brexit? No one knows what's going on there. You have a view?
No, you know what? My view is I'm actually pretty bullish on the British pound, because I think no matter what comes of this, I think whether it's a messy exit, a no-deal Brexit, or this or that, I think there'll be an adjustment, but life will go on in the UK. And I think that the level of the pound has priced in a lot of bad news. So when I go through in my head all the different scenarios, I see the pound actually having a nice rally regardless of how this takes place. So I don't know what the outcome is going to be in terms of the details, but I actually like the British pound here.
All right, and why don't we wrap it with the 10-year yield? We recently bottomed around 254 or so. Peter rallied to 275. I actually think we might make a move to 290 and then down again if we get risk off. You have a view on the 10-year?
Yeah, I still think yields are heading higher. What I find interesting is, in light of the global growth slowdown and the worst equity market we've seen in a while, the worst December since 1931, the 10-year yield is still up 30 basis points from where it was on December 31st, 2017.
So not much of a flight to quality.
Right, exactly, that people are used to. And to me, a big factor in the direction of the U.S. Treasury yield will be, where do European bond yields go when the ECB, and if the ECB tries to get out of negative interest rates.
Okay. And when will that become clearer? And when does Draghi, if he's still in there, have to make a call on doing it? Do you know?
Well, they verbally said the latter part of the summer. So I think once you get to springtime, they'll hopefully start to give direction. Now, they're screwed on this, because negative interest rates has really damaged the profitability of the banking system. So they need to get rid of negative interest rates. But on the other hand, they risk blowing up the European bond market, which banks own a lot of European bonds.
Yeah, a lot of potential black swans there, aren't there?
Yes.
If they move that way. Peter, you are a voice of reason in a world of market noise.
Thanks, Dale.
And I really appreciate our conversations, and I walk away with clarity. Keep doing a great job on CNBC. I turn the volume up when you're on, and you have a great 2019, Peter. Let's get back together in the spring and see what's going on then.
That would be great. Take care.
All right, everyone. Peter Bookfar. We'll see you tomorrow for Turnaround Tuesday. You could follow Peter at pbookfar, and you could go. He'll have a link on Twitter to go to www.bookreport.com, BOOCK report.com, and keep in touch with one of the better economists that I've seen on the air. He's a go-to guy for me. So enjoy the rest of your day. Don't just count your pips, count your blessings. See everyone for Turnaround Tuesday. Adios.